ever looked at gold or silver and thought, what the hell just happened? Like, you're looking at the charts and there's, good news, like the Fed's doing something or whatever, and then gold just completely goes the opposite, or silver just randomly jumps. It feels really random when this happens. It feels manipulated even, and it just doesn't make sense. But don't worry, in this video, I will explain a secret tool called the MOVE Index and how that will help you understand what might happen in the gold and silver markets, and of course the broad market in general. Because as you'll find in these videos, learning about gold and silver will often help you learning about the broad market in general, which is always a good thing, right? But of course, this is not financial advice. It's just educational. So this hidden index, the MOVE Index, isn't even in the gold market at all. It's the bond market. If you've been watching other videos of mine, you'll notice that I talk a lot about bonds and real yields because these are the real movers of gold and silver behind the scenes. The good news is you don't need to be a bond trader to understand this. So if you don't like bonds, that's okay. This will still make sense to you. But I do recommend learning about bonds because big institutions use them a lot. So anyway, what is this MOVE Index? Well, in simple terms, the MOVE Index is basically kind of like a fear gauge for interest rates. Think of it like the VIX, but for bonds. It essentially tells you how jumpy the bond market expects interest rates to be over the next month. And because, as I was saying, gold and silver live in a world shaped by interest rates, and particularly the US dollar, watching and more importantly, understanding the MOVE Index can sort of feel like a cheat code for understanding what's going on in the market. Because it also helps you understand when things are likely to be calm and when things are likely to be trending. But also, it can even help you figure out when there might be a whipsaw mess. We've all been there. So in this video, if you stay to the end, I'm going to break down what the MOVE Index is, how it all connects to gold and silver, and how you can use it as a context tool. It's not, as I always say, to magically, predict the next trick. It's almost impossible to say candle by candle what's going to happen, to be honest. But it's kind of like, as I always say, know what's going on in the world and that will help you make better trades, most likely. It's kind of like knowing if the road ahead's going to be smooth or dangerous or icy. So enough of me talking, let's get into the basics of this. But before we even talk about the MOVE Index, we first must understand what actually moves gold and silver. Let's start off first talking about gold, because, I'm a gold jungle after all. The first thing that I want to talk about is real yields. Of course, I talk about this a lot because it's really important. But for those who don't know, I'm just going to really quickly simplify this. You basically just take the normal interest rate on a bond, and then you subtract expected inflation. So if the bond pays 4%, inflation expectations are 3%, the real yield would be 1%. Some pretty easy mathematics there. But more importantly, why does that matter for gold? Well, because gold doesn't pay any interest. Doesn't have a dividend, no coupon, nothing. Just a beautiful shiny metal. Just sits there sort of looking nice and gaining more value, most likely. So therefore, when real yields are rising, people can earn higher yield buying bonds as opposed to holding gold. Now, obviously, as I always like to say, think from the perspective of a big institution. Obviously, if you're starting out in your investing journey and you might have a few $1,000s, why would you buy bonds? I understand that. Believe me, I've been there many times myself. I get it. The whole reason to understand this is because you have to understand what the market thinks is going to happen. So whilst these numbers might not sound like much, from a big institution's perspective, all this stuff does matter. And that's a really important part in trading and investing, you'll understand. If you can think from the perspective of a big institution, I believe that'll help you in your trading. But of course, nothing I say is financial advice. I could be wrong. And then the reverse is also true. If real yields fall, then, gold becomes more attractive. And this ties into the US dollar because gold is, as you know, traded in US dollars all around the world. So what is the MOVE Index? The MOVE is essentially the fear gauge for the market. Because remember what I was saying before in the video, you got to understand what the market thinks is going to happen. Well, that's where something like the MOVE Index comes in very handy because it shows you what the market thinks might happen in the bond market. Before I go on, it's really important for me to note this. The MOVE Index doesn't show you whether the interest rates will go up or down. It's showing you how big the move would be either way. So it's really important to keep that in mind. So don't look at it and think, oh, does it mean it's going up or down? No. Okay, that sounds great and all, but what's the MOVE Index actually made of? Well, of course, it's based around the US government bonds, the 2-year, the 5-year, the 10-year, and the 30-year. Now on those bonds, traders buy and sell options, which I haven't talked a lot about options on this channel yet, but options are a very interesting thing. But essentially, you don't need to know too much about them for this particular video. Just think of it as sort of like maybe a bet on how much the price of something will move, and in this case, the yields. The price of these options contains a very important piece of information. This is called implied volatility. And this is very important, what the market thinks is going to happen. The options particularly can be confusing. Don't stress if that's you, because it is a bit confusing if you're a beginner. Just think, how big do traders think the move is going to be? Not necessarily up or down, just how much, how volatile. So essentially what this MOVE Index does is, it looks at all the options on those key US Treasury bonds. It reads the signal out of the options, and then what it does is it basically combines it all into one number. I could explain the entire mathematical process here, but it's really not worth it for this video, and it'll go on way too long. But essentially just, that's all you really need to know for now. You don't really need to know what the numbers necessarily mean, although you can look into that if you want to, and there's, of course, it's always good to learn these things, but essentially the way to look at it is the MOVE Index low, or is it medium, or is it high? Essentially, what's it doing? If, for example, the move is low, the market is basically saying, we expect interest rates to move, but not too much. The road ahead looks very smooth. However, when the MOVE Index is high, the bond market is saying, we have no idea what next month will look like. Rates could move a lot. The road looks icy and dangerous. The roller coaster looks shaky. As I said, the key thing, it's the expected volatility, the implied volatility, not the market direction itself. It doesn't say rates are going up, rates going down. It just says whatever the heck is going to happen, it's going to be a big jump or a small jump. So if you're into gold and silver, because you're watching this channel, why should you care about this index precisely? Because gold and silver are influenced so much by the US dollar and of course the interest rates, it's essentially giving us a really good backdrop into what might happen for gold and silver. So for example, if the move is high, there might be a very chaotic move in the gold and silver markets. If the move is low and says, oh, relax, it usually means an overall sort of calmer backdrop for the macro environment, which of course gold and silver live within that ecosystem. If you want, you can think of it like gold and silver are riding on top of an ocean. The ocean is made of interest rates and the dollar. And the move is basically just telling you if the ocean is going to be calm or wavy or stormy over the next month. There's also one more important detail. Just in case it wasn't obvious, I'm just going to mention this. You can't actually buy the MOVE Index, just in case anyone was wondering. I'm sure you probably weren't wondering that, but just in case you were, you can't actually buy the MOVE Index. It's like the VIX. It's just a signal. It's a piece of information. It's not a trade by itself unless, I don't know, some CFD lets you trade it, but who knows. Which is fine because we're using it as a tool, just like the many other tools I recommend using on this channel. The gold-silver ratio is one of the really good ones, by the way. If you've been following a lot of this, you'll see what I'm talking about. So moving on from the basics now, I'm going to give you some scenarios and some ideas of what can happen in the gold and silver markets based on the MOVE Index. Remember earlier, as I was saying, gold cares a lot about real yields and interest rates and the US dollar. Gold particularly does react to fear in the markets. The move really sits behind all this. It tells us how wild the interest rates might be. Anyway, let's start with a low move for gold. Well, the low move basically means that the bond market expects interest rates to move around, but not too much, not too violently, not too quickly. So in other words, it means we don't expect any big surprises. So what does that mean for gold if it is low? Well, basically what it means is moves in gold at this point are going to look a lot more logical. The price tends to respect trends a little bit more in this case. If the macro backdrop for gold is overall bullish, which it is at the moment, what this can mean is gold will continue to grind up more smoothly. But of course, it doesn't mean that gold can't drop. So before anyone's thinking, it doesn't mean that gold can't drop, obviously. It's more just the style of movement is more like a smooth road rather than an icy one. Now, in a low move world, there'll be fewer insane spikes. And if you see a pullback, it'll be like, oh yeah, okay, that makes sense. It won't be too crazy, the pullback, if that makes sense. It'll be a regular pullback, depending on how much you're looking at the charts, or what type of investor you are, obviously. Some people just buy gold and that's fine, but if you're trading, for example, this matters a bit more. Now, if it's a high move, well, this is where things get very interesting. A high move basically means the bond market is saying, we really don't know what's coming. Interest rates could jump in either direction. For gold, this means the environment is much more chaotic. What might that look like? You can get really big intraday swings in gold. The first move on a big data release can be completely wrong and reverse. I know I've seen this a lot myself personally, someone who watches the news. I have personally seen this one quite a lot, and that's how I've dug into this and wanted to make this video. Because I had a trade and yeah, interesting, but yeah. You see fake breakouts a lot as well. And you'll see the typical stop hunting behavior, if you know what that means. The important point to keep in your mind here is it's not even telling you whether gold's going to go up or down. That's the whole point. It's just basically telling you whatever gold does, it's going to be crazy in a much messier way. So depending on when you're watching this video, because I realize I might be making this video and you might watch it a year from now, so I want to keep this relatively accurate. So if, for example, gold for some magical reason becomes bearish, it could happen for a while, I guess. In a high move environment, you'll get more noise basically in that environment. And of course, that can mean more emotional pain depending on the type of trader you are. If you trade, of course, as opposed to just buying gold. So there's the same view, but with a different risk. So how can the move change your approach? I'll give you a simple example. Let's say you logically, as a person, have a bullish view on gold. Wonder why that would be. The overall conditions of the market might be relatively similar. However, the move might have changed, and therefore the behavior of the charts might also change. Now let's talk about bullish gold, but in a low move. Just so this really makes sense to anyone watching this. And you can really go away from this video and start actually implement this knowledge. I always recommend implementing this knowledge as soon as you get this video. If you were, say, trading gold and the move was low, you might take a relatively normal position size and have a tighter stop loss, for example. And then you might expect a steady grind higher as opposed to a big jump. So you might take a longer trade, for example. Now, of course, if the move's high and gold is bullish, you might have to use wider stops depending on what point on the chart you're trading in, what time frame and all that. And also importantly, it's really good to understand this. Mentally, if you know the move is very high, you'll be prepared for some whipsaws. That's for me, like when I'm prepared for something big in the market, I don't get as shocked by it. That's one of the things for me. I have to, my emotions are quite a big deal. I intellectually understand what's going on in the market. My mind is like, oh, what's going on? I'm just being honest. So that's why we have to, as people, we have to help each other get better at trading and investing. But I'm just going to reiterate this so it's 100% clear. The move should not change whether you're bullish or bearish on gold or silver. That's really important. Don't look at the move and say, oh, the move is, because I understand it would be tempting if you didn't know better to look at the move going up and think, oh, gold's going to go up, more chaotic. But I wouldn't recommend using the move for just that. When there's an event coming up, that's when the move becomes even more important. If the Federal Reserve's about to meet, what the move is doing is very important. Or if, the US inflation data is going to be released, maybe major labor market releases, or even surprise government banking headlines. If the move is high going right into these events, the message is kind of like, nobody really agrees on what's going to happen next, so expect fireworks. For gold, that can mean massive fake outs on the first reaction. This is the one I've seen happen. And then you get that, that massive, huge candle up and down. If you want, you can just look at get the chart out now and go and watch the full video, please. But after you've watched this video, get the chart up and just go back. Just scroll back and you'll actually see examples of this. This actually happens quite a lot. You might even see news headlines that say the exact opposite of what it was saying 24 hours ago. The move is almost like a warning label that says, don't be shocked whatever happens. Don't be shocked if gold starts behaving like a messy drunk person. If I really wanted to boil this down to just one simple thing to make this easy to remember, because I know it's easy to talk about this in a video and it's easy to even understand this, but to actually go out and keep that in your mind, that's the thing that I want to drill into you. Just think real yields and the dollar, they'll tell you the direction story of gold, where the move itself is going to tell you how violent the move might be. Now, of course, I'm going to apply this to silver just because silver has gone absolutely insane this year. So I feel like we're near the end of 2025 right now. I feel like silver has gone absolutely insane, which has shocked even me, to be honest, because I didn't think silver would go like that. So anyway, I'm more of a gold person, but silver has gone crazy. Well, here's the thing. So a high move can turn silver into gold on steroids. So as you know, silver obviously cares about these factors such as real yields and the US dollar. However, silver is also industrial. Very important to keep that in mind. Think of just things like solar panels, electronics, all sorts of stuff. Probably the device you're watching this on. I mean, it's in a lot of stuff. Silver's much more common, even in microwaves, it's in a lot of stuff. All the stuff I just mentioned about gold, add on with silver that silver reacts to expectations of future growth, manufacturing, and tech. And of course, silver is usually a bit more volatile than gold. I saw this really random analogy once about gold and silver. It was like gold is like the older sibling who's very serious, and silver is like the young sibling who sort of copies what gold does, but in a very erratic way. I do enjoy these analogies. Makes trading more interesting anyway. So if we were to talk about the high move and the low move for silver. Obviously, I'm not talking about medium, but just to give extreme examples here. Because silver is much more volatile, what that means is it can react even more aggressively than gold does. So if real yields are falling and the move is also low, in that type of environment, silver can actually outperform gold. It can grind higher with some strong bursts. Dips can be more buyable because the backdrop is calmer. This is one of those classic environments where people who love silver feel very comfortable buying silver. Now, if real yields are falling, but the move is high, then the story becomes a little bit more chaotic. Whilst gold can, of course, still trend higher overall, but with, violent pullbacks and fake outs and fake breakdowns. Silver goes into rocket with turbulence mode. You get huge up days, then you get these brutal intraday reversals. It's easy to get shaken out, even if you're right on the bigger picture. So obviously this depends on whether you're buying it or just trading it, but I'm aiming this more at people who are trading, because obviously if you buy it, it doesn't matter, you've got the metal. Of course, this can be amazing if you're able to handle the volatility, but it's good to know this in advance going into a trade, because emotionally it can be hard to hold during these times. I'm guilty of this, I get it, even if I've got a good trade, I just, my mind, it's money, so of course I'm gonna care, Or I can make a YouTube video and if it doesn't perform, oh well, didn't really cost anything to make it. But if you put a big trade on, relatively big trade on, there's consequence to this. Now that story I just gave, I'm gonna flip that. If the real yields are rising, but the move is then low, this isn't really the best thing for precious metals. Gold can sometimes see sort of a downplay, a gentler downtrend, and of course choppy sideways action stuck in a range. Here's the thing to note, silver often underperforms gold in this particular circumstance. It underperforms gold on the downside. It can quietly bleed lower and also bounce less than you might hope. This can be a sneaky type of environment that slowly grinds people down, so be aware of this. Another scenario is if real yields are high and the move is high for silver. Now this is the danger zone. Real yields are rising, but the move is high. So the market is scared about rates changing. So the market is scared about higher rates and expects big jumpy moves. Gold, we can see sharp flushes down with aggressive short-lived bounces. Silver can behave like a leveraged short on optimism. Big air pockets, huge red candles, forced liquidations for over-leveraged traders. Now let's talk about the gold-silver ratio. Very important. Why does the move matter in relation to this? Of course, I had to bring this up. I do love talking about the gold-silver ratio. I might make another video about it. If you are a good investor and watch the gold-silver ratio, as I have recommended on this channel, in some high move, risk-off environments, silver can underperform gold, which means the ratio can drop. Silver gets hit harder as people deleverage. But in high move, risk on with falling real yields, silver can suddenly explode higher than gold. The ratio therefore jumps. Silver becomes a high beta play on the same macro theme. See, the move doesn't tell you the exact ratio, of course. It just helps you understand whether those big moves are likely to be calmer moves or more aggressive moves. Try and summarize this in a really simple way. Silver is like gold with an extra industrial twist, and therefore if the move is high, that extra volatility gets turned up even more. That's why you can see certain things happen with silver. In other words, move doesn't change the basic logic of silver, but it tells you how crazy that logic might look in real time. How to use the move but without overusing it. At this point, it's really important not to turn move into some holy grail. The move is powerful, that's why I'm making a video about it, but you have to understand to use it in the right way. Think of it like the weather forecast. It can tell you if it's likely to be sunny or cloudy, of course, but it can't tell you exactly what second the raindrops are going to start hitting your face. Same with move. It can tell you, like the forecast, if the interest rate backdrop is likely to be calm or chaotic. But of course it can't tell you every tick on gold and silver, but I'm sure that's obvious to people who've traded a lot. The move is good for some very specific things. The volatility regime check. Are we generally in a calm environment? This can also help you decide how big your position on trading could be, how much risk you're willing to take on. Of course, how wide your stop can be. And more importantly, I would argue, how much emotional noise to expect. There's also some event warning risk. When the move is elevated around Fed meetings or inflation data or big labor market releases, it's basically saying this week could get wild. Don't be shocked if gold or silver whip around. It also can give context for some strange price movements. If you've ever looked at the charts of gold and silver and the behavior of the chart just looks wrong compared to the usual logic, this is where the move can tell you. This isn't about gold or silver specifically. It's a macro volatility shock coming from bonds. In other words, move gives you context, not a buy or sell signal. Now, what is the move not good for? Well, it's not directional. It's not timing. And of course, this is obvious, but I'll just mention it anyway. It's not a replacement for other signals, but I feel like that's self-explanatory, but I just thought I'd mention it in case anyone's beginner. I don't want to leave anything out, because you still need to use real yields, the dollar, the dollar index, of course, basic macro data, the usual stuff that I talk about, the news, of course, your own experience, your own levels, your structure of trading, all this other stuff. The move is like a layer on top of that, though. I'll give you some simple rules of thumb for trading the move. Make sure you look at the move on a much larger time frame. This is important. For most people, realistically, if you look at it once a week or even before a major trading event, is probably enough. It's not the type of thing you have to obsess over the daily changes. It's very good to treat this as a position sizing tool, which is then to be combined with tools such as real yields and the dollar. All the stuff I talk about in the channel needs to be used together. This isn't about just looking at one tool, it's about using it all together and becoming an educated investor or trader, whatever you do, or both. Doing all this will put you ahead of many, many people who retail trade. And remember, you're looking for context, not prediction itself. Using this shift, understanding what it's used for, it's like a cheat code to help you. It's not a source of noise. So if you remember nothing else from this video, please just remember this. Gold and silver don't move in a vacuum. They move inside a world shaped by interest rates and the US dollar. Move simply tells you how stable or unstable that world is. I hope you found this useful, and thank you very much for watching, and I'll see you on the next one.